going to talk a little bit about market efficiencies, especially with regard to the AQR case in the final part of today's tutorials. Okay. Now, what I want to say is, so first of all, what have we learned in this course? Okay. Now, I think to some extent, this course is about the debate which is still going on between people who believe in behavioral finance and people who behave in efficient markets. And people in the school of behavioral finance, they believe in two things. First of all, that markets are not efficient. So some people can beat the market, okay? And on top of that, there are certain specific market anomalies, such as small firms versus big firms, or high book value versus low, or momentum stocks, or CAPE, or whatever you want, okay? Which they claim can actually predict future market directions. Number one, right? Efficient market people. Efficient market people, on the other hand, they believe that it is not possible for anyone to beat the market, and they have three different definitions of market efficiency. I'm kind of summarizing, a large part of the last few lectures into 2 slides and 6 bullet points. This is something that someone asked me on Friday, I think, okay? And I try to be clear here. People from the School of Behavioral Finance actually think CAPM is a good enough platform for stock valuation, and it adequately characterizes the risk-return relationship of, companies, stock prices. The important point is, when it actually fails to do that, it is because of certain temporary anomalies. So the School of Behavioral Finance people, they think that CAPM is already good enough as a model, all right? And they do this. I'm going to use big R, the excess market return. And when it fails, they're okay with that, because they never said markets were perfect. They would say, oh, you know what? There is some alpha out there, okay? Now, this is what the behavioral finance guys would say. Now, the efficient market people will say, no, that's not true. This so-called alpha actually can be broken down further into whatever other, it is nothing more than risk compensation for, high minus low, whatever they call it, okay? Or big or small minus big, okay? SMB. So they say that these so-called additional returns are nothing more than compensation for additional risks. Is everyone okay so far? Is everyone okay with that? Yeah? You, at least, I'm not asking you to agree when I say, are you okay? I'm saying, do you understand what I'm saying? Okay? So now, there are 2 problems I have with this. Okay? Number one is, you're going to keep adding beta. You're going to keep adding factor to it. Every time they discover a new factor, a new anomaly, potentially you keep adding to it. It's like you're moving the goalpost. Right? You keep moving it. And you just keep saying that there are new factors. That's the first problem. The second problem I have with this is they even say that, and this is related to your AQR case, which is about momentum. Okay, so when there are momentum stocks and then they use another factor, okay, UMD, up minus down, and they claim that, well, you know, stocks with high momentum, you know, they give you a higher return because there is higher risk. High momentum stocks have high risk. I mean, and I'm thinking, yeah, what is the logic behind that one? Okay, the reason being, if you are a small company, at least I can tell you are a small company, or if you have high book value, okay? Now, for momentum stocks, it's price driven. So it's got nothing to do with whether you are big or small. So one day you might be, maybe you don't have any momentum. And then next month, suddenly you have a lot of upward momentum. So why does that suddenly make you more risky? I don't really follow the logic of that. Okay, but anyway, so this is what the School of Efficiency. This is what they say. Okay, and then once those anomalies are included, once you break down these so-called alphas into the subcomponents, you'd find that the alpha actually can be accounted for by these factors, which are nothing more than compensation for risks. Now, I think it's very hard to get around an argument like that. You just keep adding factors to it. And in fact, thus leading to the conclusion that markets are efficient and stock returns are completely accounted for. But what I do want to say is I want to just quickly take a look at the AQR paper, and then I'll let you go. Okay? Because some of you were asking me questions, and I want to be, I want to give you some hints without, you know, I can't do your homework for you, but I'll give you some clues here and there. The first thing I want to say is when you turn to Exhibit 3, okay, the way to read this is what you should do is you can draw a line here, okay? You draw a line here because this is the sort of demarcation between the School of Behavioral Finance using the CAPM and the efficient market people. Now, what is going on here? So what you have is okay, let me take one step back. Okay, so here what you're doing, okay, let me refer to this first. Okay, so here, Exhibit 4, the methodology here is that you take, let's say the market has, let's say it has 1,000 stocks. Let's just say it has 1,000 stocks, okay? So that is your investable universe. So what you do is you look at over the last 12 months, and you are going to group your stocks in 10 different portfolios with the best returns. I think it's from, so if this is now, all right, so you look at, now is T, so you look at from T minus 12 to T minus 2. So you ignore the last month or two. So from here to here, you're going to form 10 portfolios. So the best one will contain you all the best winners, and the worst one is all the losers in the last 10 months. So you're going to have 10 portfolios, and each of them will have 100 stocks, okay, because you have 1,000 stocks. And now, so let's say you invest $100 in each of these portfolios, but you do not invest like $1 per stock. No, you don't do that, okay? In these little percentile portfolios, you do it on a value weighted basis. So the bigger companies will get a bigger allocation, okay? And then what you do is you want to see how it performs, from this point. And then every month you will rebalance. Every month you do the same thing. And this is the result. This is a table of measuring the real losers in the last year versus the real winners. Now, notice that just because you got a portfolio with a bunch of losers, you can still beat. So here it actually has beaten the second percentile and even the third one. Okay, doesn't happen all the time, but in this year it did. Okay, so here it's 14.7, so this is less than this one, as you think it might if you believe this strategy actually works. Okay, but then this one is actually better than this. But you see there is a pattern, so that, wow, look at this one, 89.3. Okay, so there's real momentum here. That's the first point, how these tables are calculated. Second point, so exhibit 3, as I said, you can draw a line. You can draw a line here, all right? And what this is saying, first of all, if you look vertically, all right, this is the portfolio in decile. This is the loser. This is this one here, okay? And this high here, this high is the winner, okay? Now, one thing important, okay? These numbers, this 2.42, this average return is when you buy this portfolio, okay? So because it's a short here, you actually have to turn it around. So this one, if you long the winner and you short the loser, it is 20.42, okay, minus 2.42, which is 18 or 17.99. It actually gets more interesting when you come down here and you look at the alpha, okay? So the winning portfolio has, according to CAPM, okay, the CAPM alpha is 18.57, but 11.23, I beg your pardon, okay, for the winning portfolio. The alpha for the loser portfolio is actually minus 7.34. So when you long the long one and you short the, when you long the winner and you short the loser, it's actually 11.23 minus 7.34, which is why you get 18.57. Okay, so I'm just trying to help you interpret this exhibit here. Okay, that's the second point. The second point is that when you look vertically, okay, these numbers represent what happens when you are long this portfolio. So when you do this, if this is A, this is B, C is equal to B minus A, okay? Point number 3 is so in come the efficient market people, and they say, look, these so-called market anomaly or alpha, okay, can be explained, and they have actually a 4-factor model here. What are the 4 factors? The market return, the high minus low book value, the firm size, and then the UMD here. Okay, and again, when you, well, two things I can mention. One is once you do that, the line should be here. Once you start doing that, all right, you see that a lot of the so-called alpha previously, according to the CAPM model, the alpha of this strategy is 11.2%, but now it's down to 4.44 because a lot of it can be explained away if you break them down into beta factors and these so-called factor loadings. Okay, these are the risk premium that are reward or compensation for you to take these risks. It is not clear what the actual betas are, but these are the factor loadings. These are the risk, the risk premium. Okay. No, you can't add up betas like this. For example, Madeline, okay, for example, you just have to look at the first one, multi-factor loading, RMRF, okay? This one is trying to tell you what is the market excess return, okay? So the other ones follow the similar logic. Now, I'll say a couple more things. First of all, somebody asked me a question, and I guess in all fairness, I should mention this in the appendix, okay? So for example, and please listen carefully, all right? So here, this question is asking you to calculate various combination of the strategies. This one, UMD spread portfolio return, and I actually have, okay, first of all, what is this? Okay, this is simply, if you go to the data, okay, you take 10 and 9 and 8 minus 3 and 2 and 1, okay? Now, I have students asking me, why is that not the same as what you have over here, all right? Did you have that question? Yeah? Okay. I was just, I had a dilemma whether I should answer that or not, but I guess if you are confused, I'll try to let you know. This is based on all of these, whether it's UMD or small minus big or high minus low. These are based on the so-called Farmer and French 3-factor or 4-factor model. These are, forgive me for saying this, actually quite simple strategies. They do not, as far as I can tell, they do not incorporate any kind of value weighting, okay? They are not value weighted. In other words, there is no reason why they should be the same, okay? One set of data is provided by Professor Farmer and Professor French. The other set of data is provided by these AQR guys, and they use value weighting anyway, okay? So do not think they should be the same. I think maybe the question, because it says UMD, maybe you got confused, okay? But do not expect they need to be the same, okay? Not the same. The other thing is regarding the use of risk-free rate. Now, this paper, as you know, was written in, what was it again? 2012, okay? So we don't mind you use the risk-free rate or you do this, just don't look ahead to see what happened to the company. I know you can't resist the temptation, okay, but try not to. Certainly do not incorporate any available data here into your calculation, okay, because then you are kind of cheating in a way. No, not cheating, but that data wouldn't be available to you at this point in time, right? So you shouldn't be doing it. Okay, I think that should keep you going with the AQR project. I think I have pretty much mentioned all the things that you need to know. Now, if you have questions on this, I would much rather you tell me, you ask now, okay? Because I'm on record and I'm going to share this with T1 and T2. They never heard the last 20 minutes on Friday. I would like them to. I'm going to produce this video and share it with them. If you have some questions on AQR, put your hand up. Yes. I'm sorry? Should you treat the risk-free rate as a constant? I leave that up to you to decide. What you should not do is use any data after 2012. Okay. You want me to help you on that? Just look for some proxy. Okay. Just look for some approximation. All right. Is everyone okay? Getting hungry? All right, I'm going to let you go. Thank you for coming. Thank you for listening to me. And this week, we just need to have your AQR report on Wednesday. Okay. All right. Thanks, everyone, and have a good week ahead. Okay. This will be available if you want to listen to it. I'll try to get it produced by the end of today. Okay. Thanks, guys. Bye-bye.